All right. So now we've got our two assets. Okay. You know, I talked to you a bit about diversification. Remember those random walks that we did? And then they're all like really, really noisy. But then when we take the sum of them, it actually gets really smooth. So it's called diversification. So generally what I do is I measure the performance of a strategy in terms of the Sharpe ratio, right? And so when we look at the NASDAQ Index and the S&P 500 index, they're actually trading strategies. The S&P 500 and I think the NASDAQ as well, they're both market cap weighted indices. So they have, 500 of the biggest assets by market capitalization. And then every 3 months or so, some of them drop out because they're too small and some others come in. And so in a sense, that is a trading strategy in itself. We can see that actually the NASDAQ index, so the QQQ and the SPY, that they're actual trading strategies. And so if they're trading strategies, in order to assess whether they're good or not, what can we do? What's the best metric to use? What's the one that I used?
The Sharpe ratio.
Sharpe ratio, yeah. I don't usually use profits because it's much better to use the profit as a unit of risk. So what I'll do here is I just simplify my stuff even more. So I actually call this PCT change of the close prices reds for returns. And then I go reds dot cumulative sum. And so I get the same thing, right? But what I can do now is I can calculate the Sharpe ratio for both of these strategies. I can go reds dot, do you remember the Sharpe ratio?
It was R dot mean divided by S to D and then multiplied with 16.
Can you explain it in normal words again? It's the average return. The mean is the mean of the return. So when we do reds here, we dot mean, what we're actually saying is we have the average of our returns divided by the standard deviation of our returns. Reds dot standard deviation. And we multiply this with what number?
16.
Yeah. Why? It's the square root of 256, which is the number of trading days in a year. So we're basically making an assumption that the year has around 256 trading days. So 256, the square root of that is 16. It just keeps it simple. And we don't have to be perfectly accurate. These are just numbers for comparison. We're not trying to be perfect here. We're not trying to be fancy here. Have a look at these results. One of our Sharpe ratios is 0.62 and the other one is 0.44. You remember that we can look at diversification. So one of the things we could say is, well, what happens if we combine these two strategies? Do we get a better Sharpe ratio? Does it improve a little bit? Maybe those two strategies are diverse or different enough that maybe our Sharpe ratio might get better. So how would we go about in calculating the Sharpe ratio of the two strategies together? It's quite tricky. I tell you how we do it. So think about it. We've got our returns here, yeah? So this is our reds, yeah? And there's two columns in here, okay? And so actually adding up is not really that bad an idea. But what we need to do is we need to add them up row-wise. Basically create a compounded thing. But when you think about it, let's say we put half of our money in SPY and the other one in QQQ. Adding up isn't really the right thing. What we actually do is we need to take the average of the returns. So we need to take the average of each of those returns. Yeah. And the way to do this is we go reds.mean, but now so what we did before was when we did mean, it was actually taking the average column-wise. But now we want to do it for the rows. And so what we have to do is we need to go axes equals 1. That now we're taking the average across the row and not the column. So if we do this, you will find that we just got one resulting. See, we got one resulting, yeah? And so what we can do now is we can actually just take the mean of that, yeah? which is basically average of that column, averaged all of them. But then we also need the standard deviation, right? We want to calculate our Sharpe ratio. So what I'll do is I copy and paste this. Instead of mean, I go divided by STD.
Multiplied with 16.
Awesome. So now what we can do is we calculate our Sharpe ratio for the combined strategy. There we go. It's 0.552. So it's not quite as good as just investing into QQQ, right? So it's like, maybe we should put all our money into QQQ. Okay. So, you know, it's not perfect, but what we could do is at least maybe have a look at how the strategy performs in a plot. So we just go again, cumulative sum dot plot. And so this is basically the strategy, right? How it would perform.
Couldn't we say that it is technically like just that we take 0.62 and 0.44, add them together and divide them by 2? Isn't that what we just did, right? Like simplified?
You probably could. The thing is, when it gets more complicated, that doesn't quite work anymore because it's time-wise, right? Let's say you had a strategy that only trades half of the time and the other strategy trades the other half of the time. Let's just say those two strategies were totally uncorrelated, then the Sharpe ratio would actually be much better. Okay, let's do this. Let's just add them up or just average them. And you will see it's not perfectly the same. Sorry, times
16.
See, it's 0.53. So the reason for that is when you actually average them across the column, it's not the same as just taking the average of the two. And in fact, if you have two strategies that are very different from each other, quite often you end up with a better Sharpe ratio when you combine the two strategies than the two different strategies combined, right? It depends very much on the correlation between the two strategies. So if the strategies are very uncorrelated, then you would actually end up with a better Sharpe ratio. But in this case, the strategies are pretty correlated. Yeah, let's just have a look at this. So if we actually calculate the correlation of those two, we could do this with reds.co. So basically we have a correlation matrix here, and you can see they are 91% correlated.
Interesting.
So they have an extremely high correlation. That's why you would hardly ever get an improvement in the Sharpe ratio if you just add the two strategies together. Now, the question is there a way maybe to, if you really want to, let's just say we have a pool of money and we can't just invest in one, but we have too much money. We have to invest into good problem to have. What do you reckon? Is there maybe a way to improve on this Sharpe ratio 0.55? Figure out a way how we could actually improve that?
Probably, yes. I just don't know how.
Yeah, what do you just give me an idea? I mean, you see that the thing with trading is you got to be creative. Maybe you can find a creative idea to do this. It's tricky, isn't it?
What I heard or learned is that if you have like two different like indices or something, and there's always like a pair correlation somehow with them, that if you trade the one in, I don't know, let's say like a long or something, then you can trade the other one as a short because they're related somehow.
What you're describing is a process called statistical arbitrage. And you're right.